Welcome to Brookstone Financial. It's been a while since we've seen you, and I've actually had several clients ask, when are you guys going to start doing these short videos again, and what better time than now? The markets have seen a lot of turmoil over the last week. With the outbreak of the virus, a lot of people are very uneasy, wondering what to do, if they're in the right place, do we have them allocated correctly? And ultimately, folks, what this comes down to is keeping your cool for the time being. You have to realize that investing is about the long term, the longer term time horizon. But that being said, we also have to position assets that if we need access to money in the short term, that we're not going to an account to make withdrawals when it's down in value. So let me show you why we do what we do and give you a quick example of why we do what we do. Typically, when we're working with clients, we like to have a portion of their portfolio safety of principal. The other portion, if it's going to be in the market, we want to focus on the things that we can actually control, and those are fees and risk. We can't control where the market goes, but we can control the amount of fees and the amount of risk we're taking. So ultimately, we start with what's called Rule 100, and this is just a rule of thumb. So Rule 100 says you take 100 minus a client's age. We're going to say we're working with an individual that's 55 years old, and that gives us 45. That would be 100 minus 55. It's 45. Put percentages on those, and their age represents the amount of safety that they should have in their portfolio. So the 55 would be safe money, the 45 would be money at risk. Now, what this is saying is the older we get, the less risk we take because we don't have the time to make up for those losses. So let's take this household allocation. And when I say household allocation in a married couple, we're talking about assets on both sides and the combination of those two. So we're going to overlay Rule 100, split this little pie or this household allocation. Over here is our 55%. All right, over here is our 45%. So how are we going to allocate that money? Well, in the past, it was as simple as, a lot of brokers thought it was simple as stock and bond. Now, the problem with bond right now, or bond funds in particular, is the interest rate risk. Typically, when interest rates are down, bond prices are high. Interest rates really have nowhere to go but up in the future. There's very little downside to interest rates, which in my opinion means that bond funds have a lot of downside in the future. Now, and a lot of folks say, wait a minute, Seth, I've done really well in my bonds or bond funds over the last 10 years. Well, think about where interest rates have been going over the last 10 years. They've been falling, which means the value of your bond funds have been rising. So we're looking for alternatives to our fixed income allocation of our portfolio. Let's talk about the stock allocation first. Now, a lot of folks use mutual funds, and I don't think there's anything wrong with mutual funds. We as well use mutual funds and allocations, but oftentimes we focus on dividend-paying stocks, individual, well-diversified, blue-chip dividend-paying stocks. So what I saw in 08 and 09, if you think about the last financial crisis, when everything fell, stocks and mutual funds kind of fell in tandem. On the recovery, on the upside, we saw the individual stock portfolios rebound much faster than the mutual fund portfolios. So typically on this side, we're going to focus on high quality dividend stocks. Typically, dividend ranges are going to be in the 3 to 5% range. Dividends are pretty predictable. That means cash flow. What's not as predictable is the price of the stock itself. They will fluctuate, but if it's still paying a dividend, you have that income in retirement. Dividend stocks. Also, dividend stocks do not have internal fund expenses like mutual funds. That's why I believe that this allocation of individual dividend stocks may be far more efficient than using mutual funds. Again, well diversified. So over here, we're going to use indexing strategies, in particular fixed annuities are a great bond alternative. And here's how they work. So indexing or fixed indexed annuities have a starting point, and it's a snapshot date. We'll call that a snapshot of the S&P 500. In this example, I'm going to assume we have a 50% participation rate. Okay, that's important. And here's my starting point. Take a snapshot of the S&P 500. What is the number on that date? 1 year later, we're going to say that the S&P 500 is up 10%. Well, in this type of annuity, you're not going to get 10%. Remember what I said a minute ago, 50% participation. So 50% of 10 is 5, okay? So you don't get all the upside. That's the trade-off. Now, let's say year 2, we do see a significant market correction or long-lived correction over the course of the year. Market goes down, 15%, okay? In a fixed indexed annuity, you're not going to lose, and you're also going to get to keep what you earned or what was credited to your account on your previous anniversary. So once that interest is credited on your anniversary, that is your new principal, and you cannot go lower from that point unless you take more money out than what it's earning. So year 3, when the market recovers in this hypothetical, we'll say the market's up 10. This type of annuity, again, would be up 5. Because that's the 50% participation. So you're giving up some of this in the good years in exchange for protection from that in the down years. Now, ultimately, these types of annuities average somewhere in the 3 to 5% range, which is similar to bond yields. That's why we use them as a fixed income alternative. Now, one of the downsides of these types of annuities is limited access to your money, and that's extremely important. Now, many companies, most companies that we work with, allow up to 10% penalty-free withdrawals from these annuities each and every year after the first year. You have to leave it put for the first year. But here's how I address that. I always tell people, and there's so much truth to this, no matter where you put your money, you put it under the mattress, you put it in the market, you put it in CDs, money markets, or fixed annuities, if you take 10% of your money every year, what's going to happen? You're going to run out of money. So a 10% annual rate of withdrawal without penalty, no fee, no loss of interest is a very reasonable degree of access to this portion. But again, keep in mind, this is dividend stocks, individual stocks, 100% liquid. This is why we do what we do. It's weeks like this in the market, because weeks like this in the market, is this portion of our client's portfolio down a bit? Sure, but this portion right here, they lost 0, nothing. So this really deadens the blow in volatile markets. Typically, we expect this type of model to average somewhere in the 4 to 6% range, maybe even 5 to 7. Obviously, some years are going to be better than others. We're not chasing returns. Folks, this is the tortoise and the hare. Slow and steady wins the race. If you want to learn more about Brookstone Financial or the strategies that we employ for our clients to generate lifetime income streams and help them plan for retirement and be more tax efficient and really enjoy life and not have to worry about the ups and downs and the roller coaster of the market, give us a call. Our phone number is 812-288-9000. Again, that's 812-288-9000, or visit us online at brookstonefinancial.com.